Very good afternoon, everyone. Thank you so much for joining in for our session today. This is a very, very special session for us, and also I think we feel the same. It's going to be a very, very special session for the audience today, since we've seen the aftermath of COVID, and we've seen a lot of people suffer due to a really, really exorbitant hospital bills that we've seen. Right, a lot of people had to sell their properties, sell their assets, and pay these hospital bills because they didn't have the necessary, or they didn't have a proper insurance policy in place. Now I understand we all have our health insurances from our organizations that we work with. I'm sure a lot of people who've joined also have their organizational policies in place, but they are covering you to a certain extent, right? What happens if the bill is about 10 lakhs or 15 lakhs? How do we sort of uh, make arrangements for these unforeseen circumstances, right? So we have Akshat Malhotra today with us, who's going to take us through this journey of personal insurance, and he'll speak about policies that are very, very important, are required to have in order to suffice any hospital bill up to maybe 20, 30, 50 lakh, right? So Akshat, a warm welcome to you. Thank you so much for doing this for us in the first place. Over to you.
Thank you, Shiva. Thank you once again for having me here. I'm always excited to do sessions through Ethika, because I think the audience here is super energetic, super interactive, and the energy and the interaction gives me the energy to successfully facilitate and go through these teachings. Super happy to be here. And as you said, I think this is one topic which again is very, very close to my heart personally as well. Primary reason being because I feel this is one place where, in spite of all the education out there, we still make mistakes, right? And mistakes here really, really cause a lot of trouble to us, to our families, so on and so forth. So yes, having this opportunity today, I'll try my best to make sure the people attending this session do not make these mistakes ever again, and successfully they are able to make sure, they're able to run through their financial plan along with taking care of the insurances. Okay, so we can get started. I think I'll go ahead and share my screen quickly so all of you can see it. And yes, as always, so for those of you who've attended some of the sessions we've done earlier, you know how much energy I need from all of you. So as always, and I know a lot of you must be thinking, Akshat, you always say this every time, but honestly, as always, I've not had my lunch. Okay, so the only way for you to give me that energy, to give me that food, is to share your thumbs ups every now and then. Yes, Pooja has been there earlier. That seems it seems to be awesome. Thanks, Pooja, for that support. Right, so I need continuous thumbs up throughout the session so that I can successfully take you through these slides. Right? Awesome. Are you all set? Are you all ready to attend this session on Let's Talk Insurances? Can I once again have a quick round of yeses or thumbs ups on the chart, just to see how eager you are to learn? Lovely. Okay, perfect. So let me go ahead and get started. Session 3 on the series that we are doing. So we've worked through creating a financial plan for yourself, understanding the basics, how do you go about diversifying, and then finally creating a financial plan for yourself. We've also done a deep dive into mutual funds, as to how do you select mutual funds, how do you technically analyze mutual funds, and how do you go about investing into them. And finally, now we are going to talk about another important aspect of our personal finances, which is insurance, right? Quickly, a disclaimer, we at Pennywise are financial educators. We are not trying to sell you any sort of financial products. We want to give you the right sort of knowledge, and same goes with Ethika. We want to give you the right sort of knowledge and give you the assistance in order to buy your financial products. If you ever need any help, you can reach out to any of the teams. But at the same time, any examples that we take, any companies that we name off, there might be a couple of calculators that I'd be using today. I just want to reaffirm that we are not here, affiliated with any of those companies to directly sell you their product. Okay. So yes, now that we've learned about all our investments and everything, there is one more thing which is more important than investments. Guess what is that? Any guesses? You can respond in the chat as to what do you think is more important than your investment. I think we've already made that answer very, very clear. I think most of you now understand that, but still, what is that one thing which is more important than investments? Pooja says knowledge. Very true. Knowledge hoga tabhi. That's only when we can do something. Very, very true. Savings too. Unless and until we don't have savings, we can't do investments. Insurance. Yes, I'll be super honest. Insurance was the word that I was looking for. Right? I think we shouldn't have started with the session telling you it's about insurances, right? Maybe that would have been a smarter way of getting an answer to this question. But anyways, you all get the point, right? So it is super important. Insurance is in a way even more important than investments, because unless and until we do not secure ourselves, what's the point of securing our future, right? We do invest, we make investments to secure our future, but if we are not there in future, what will we do with those investments, right? In a nutshell. So having said that, let's quickly begin on what an insurance is. And I'll try to explain this in the simplest form, or maybe give you a definition in the way that I understand insurance, and completely in a layman term. Insurance is buying a protection. It's buying a protection against any of the health issues that could happen, against a death, untimely death that could happen to us or to any members of the family, or anything that could go wrong, which could have a financial impact to our life. As simple as that. Insurance is buying a protection to cover ourselves against any unforeseen circumstances. As simple as that, right? There are predominantly three types of insurances, right? Life insurance, general insurance, health insurance. Health is also kind of a part of general insurance, but I've just kept it separate to emphasize on the importance of it. So life insurance to cover our life, right? In case something happens to us, then we have an insurance that can pay the claim for, pay us the money for that insurance, right? At the same time, health insurance, in case something goes wrong with our health and we need to be admitted to the hospital, so that, we are able to also take care of our expenses related to the hospital, right? And general insurance about, insuring your phone, insuring your home, insuring your any of the other gadgets or any of the other things that you have, that usually comes into general insurance, motor insurance, so on and so forth. Okay. So let's talk about life insurance. And for a second, for the next 10, 15 seconds, I'm not trying to spread negativity here, but maybe just close your eyes. Just close your eyes for 10, 15 seconds and think of a time that in case something happens to us, what will our family do? In case something happens to us, do we have enough financial stability or security today that our family will be able to lead the rest of their lives without being dependent on anyone else? I hope you all have the answer, right? Now, the reason why I did this, once again, I'm sorry, I didn't want to take you into that mode, but I just wanted all of us to realize that yes, as much as I'd love for all of us to live as long and as healthy and hearty as possible, we've seen what happened during the COVID times, right? We've seen unforeseen circumstances can come up at any point in life. And so it is super important. It is super important to be insured, to cover ourselves, so that in case something happens to us, our family is not dependent on anyone else, right? And so it is super important to have a life insurance. You don't have a life insurance, yes, I too like to live dangerously, right? So it's kind of just like living on the edge is what you call, right? Something of that sort. So yes, please do not do that. It's super important for all of us to have a life insurance. Now, talking further about the various types of life insurances that are available to us. And before I do that, I want to quickly touch up on two important terms. One is called a maturity, and other is called a death benefit, right? So, what is a maturity benefit? Now, insurance plans, I'm sure all of you already know, right? They are structured in a way that you keep paying premium monthly or yearly for a fixed period of time. And then, let's say if it's a 10-year or 15-year policy, then you keep paying your premiums. And at the end of 15 years, if something happens to you within those 15 years, obviously your family gets that money. If nothing happens to us during those 15 years, then we'd get a maturity amount, right? So basically the policy has matured, everything was good, nothing happened, and then we get whatever premiums we paid plus additional some bonuses, we'll get it back, right? So this money that we get at the end of the maturity period if nothing happens is called a maturity benefit. And in case something happens to us and our family gets that money, that is called a death benefit. I know death benefit sounds really funny, but yeah, that is what it is, right? So endowment plans now are the plans that come with both a fixed amount on the maturity, both a fixed maturity benefit, as well as a fixed death benefit. So today, when you start paying your premiums, let's say if you're taking a 10-year or 15-year policy, you pretty much know how much would you get at the end of the 15-year policy, right? In case nothing happens. And if something happens, then we know how much would our family get, in case of loss of life, right? So a fixed amount right from day one is what we know on the maturity as well as death benefit. Next are ULIP plans or unit linked insurance plans. Now, as this name suggests, unit linked, it means they are somewhere related to stock markets. So what the insurance companies do is they take money from you, the premium that you give, and that money is further invested into, you could say, equities, debt, various bonds, so on and so forth. Pretty much, very much on the, same lines on how a mutual fund would work, right? They are further invested into various equity bonds, stocks, so on and so forth. So a ULIP plan is where your money is further invested into markets. Now, since you know the markets are volatile and they could be up and down, and that's why your maturity benefit in terms of a ULIP plan is not fixed. It depends upon whatever the market prevailing conditions at that time. However, a death benefit is fixed, right? In case something happens to us, our family gets that fixed amount. Clear? That's what a ULIP plan is. And finally, a term plan. And I know it sounds funny, but a term plan only has a death benefit, which means we keep on paying premiums throughout our life or whatever the policy term is. And if something happens to us, our family gets an amount, and generally it's quite a big amount, right? In terms of as compared to ULIP or endowment. However, if nothing happens to us, then we will not get a single penny back. Cool? That's what a term plan does. Now, for those of you who are in the chat, if you could quickly tell me, how many of you have an endowment or a ULIP plan? What is the premium that you're paying? And against that, what is the kind of insurance cover that you have? Anyone who has a ULIP or an endowment plan, if you could just, maybe just high on numbers as to how much is the premium that you're paying yearly and what is the kind of insurance cover you have. Okay, Siva says ULIP 1 lakh is what he's paying, 10 lakh is the sum assured. Okay. Anyone else? I don't have one now, but interested to buy. Someone say someone. 1.25 crore insurance cover, 50,000 per year. Sushant, what kind of a policy is that? Okay. Amal says, I have an endowment plan of 15 lakhs from LIC and paying 7,000 monthly for 21 years. Okay. So 7,000 monthly is almost, if my mathematics is correct, 84,000 per year for 21 years. Endowment, 50,000, 7.5 lakh years. Okay. Now, now, I'm going to break some myths here. Okay. So sorry for that. Apologizing right in the beginning. But before we get into understanding whether we have the right policies or not and what we are doing, let's let's quickly check on how much insurance do we need. What is the kind of insurance cover that we really need? This 7.5 lakhs, 15 lakhs, 20 lakhs. Is this enough? Is this enough? So let's quickly do that calculation. Let's assume that your current age is 32 years. Okay, you're 32 years of age. Your current annual expenditure is about 5 lakh rupees. Okay, so you're spending about 40 to 50,000 rupees, 42,000 rupees per month, which is your fixed expense, taking care of all the other things, and then it's somewhere about 5 lakh rupees is your annual expenditure. Your retirement age, you plan to work till 60, you want to retire after this 60, you don't want to really have any liabilities after that. And so your number of years to retire, 60 minus 32 becomes 28 years. Okay. Now, let's say I am the primary or the secondary breadwinner of the family. And let's say if something happens to me today, then my family needs enough money for these remaining 28 years to not be dependent on anyone, right? This 5 lakh rupees that we are, that I'm spending on my family or on the needs is something that my family would need even after I'm gone, because those are fixed expenses, right? And so for the next 28 years, if my family needs 5 lakh rupees, then the minimum money that they need if I'm not there tomorrow is 5 lakhs into 28, which is 1 crore and 40 lakh rupees, which is 1 crore and 40 lakh rupees. On top of this, let's say I've taken some loans, I have a personal loan or a motor loan or something on those lines. My loans add up to be somewhere about 11.5 lakh rupees. I have some life goals, right? I wanted my family, to go with my family on a world tour, renovate my house, buy a car, any sort of goals, maybe for my child's future education. So I have some life goals that add up to 25 lakh rupees. And then on top of that, I have made some investments that sum up to be about 10 lakh rupees, which in case I'm not there can be used for all such expenses. So now my final required sum assured becomes this minimum sum assured plus the loans, the liabilities I have, because after I'm gone, my family has to pay for those liabilities. And then on top of that, the life goals that I have. So I'll add all three of these, subtract the investments that I already have. And that at minimum is 1 crore and 66 lakhs. So if something happens to me today, my family needs 1 crore and 66 lakh rupees at minimum to maintain the same lifestyle after I'm gone, to not be dependent on anyone else. I'm sure there must be a common question. We've not considered inflation. 5 lakh rupees will also get increased. The reason why we've not done that is we have an underlying assumption that when your family gets this money, that will be invested into a certain asset that at least gives inflation matching return, right? The reason being, because if you consider inflation, this amount would inflate a lot, and getting a cover for that doesn't make sense. Right. So the underlying assumption is, let's say something happens to me today, my family gets 1 crore and 66 lakhs. They'll continue to keep that invested into an asset that gives them at least 6 to 7% returns that match the inflation, and keep withdrawing 5 lakh per annum, so on and so forth. Okay. But the point being, 1 crore and 66 lakh rupees is what we need at minimum. Now, tell me, 7.5 lakhs, 15 lakhs, 20 lakhs. Do you think covering ourselves with these amounts is anywhere close to what is the required sum assured? We need 1 crore and 66 lakhs. Let me round it off to 2 crores if you want to give a better life to our family. Against that, 15 lakhs, 20 lakhs. Do you think that is sufficient for our family to live the rest of their lives without being financially dependent or without worrying about money at all? No, it is not. It is not. And that is where we make the biggest mistake. That is where we make the biggest mistake. Let me pull up some calculators. Once again, as I said before, although we are pulling up these calculators, we are not affiliated to them in any way. It's just easy to explain. They have a nice UI, so it makes my life easier. So let me show you some calculations here, right? Let's say 2 crores is what we were talking about. Now, in order to get 2 crore rupees, in order to make this maturity amount of 2 crores, let me see what numbers we'll have to play with. So let's say somewhere about 20,000 rupees. If I invest for 30 years, right? I'm taking 30 years because 28, 30 is my current age, and 60 till 60 years is what I need, right? So there you go. I need somewhere about 18,000 rupees in order to get a cover close to 2 crore rupees. On the other hand, if you look at it, the life cover is still 32 lakhs. Okay. This is the maturity amount, which is calculated considering that the ULIP plan returns an 8% return. Okay. This is something that you'd get if something does not happen to you over the 30 years. However, if something happens to us, this is about 32 lakh rupees is what you'll get, right? Let me see if I can play with some numbers and see how can we make the life cover around that money, right? So we need close to 15 lakh rupees. We need, look at this figure, okay, not this figure. We need close to 15 lakh rupees every year over the next 30 years to invest into a ULIP or an endowment plan, which work very much the same, to get the minimum sort of life cover that we need for our family. 15 lakh, 15 lakh rupees. If we invest 15 lakh rupees into a ULIP plan, I don't know where will we manage the expenses, the investments, so on and so forth. Impossible, right? It's not possible to cover this through a ULIP plan. And that's where a term plan comes into rescue. That's where a term plan comes into rescue. A term plan for the 30 years in life, 2 crores of cover, right? 2 crores of cover for 30 years of life gives you 19,000 rupees annually, 20,000 rupees annually. You are able to get a 2 crore rupee life cover. In just 20,000 rupees on the same range, you're able to get a 2 crore life cover. 15 lakhs, which is roughly 1.2 lakhs a month, versus 20 lakhs, versus 20,000. 1.2 lakhs, in fact, 1.5 lakhs. I think my math is going all over the place today, but you get the point. Almost 1.5 to 2 lakhs a month if you pay. That's when you get the same life cover that you're getting from a term plan if you pay just 20,000 rupees, right? So that is the first point that I wanted to make, folks. We do not need any other plan apart from a term plan. All we need is a term insurance plan, no ULIPs, no endowments, nothing else at all. We only need a term plan to cover our life. In addition to this, now I'm sure you'll have a number of questions right now. Akshat, ULIP plan, endowment plan gives me something, right? Term plan is not giving me anything. What is this? Let's take some realistic numbers, okay? I know 15 lakh is impossible. So let's go by some of the numbers that you people had shared, right? 50,000 yearly ka premium is what I'm taking. 7.5 lakhs ka term cover is what I'm getting. About 48 lakhs is what I'm getting, right? This is what we can afford, to be very honest, yearly, 50,000 to 1 lakh. Now, let me show you another calculator. Okay. So I've put in the numbers from the endowment ULIP plan, 50,000 rupees of premium, 30 years of tenure. So we pay a total premium of 15 lakh rupees, right? Over the 30 years. Sum assured is 7.5 lakh rupees. You just saw this. The life cover is 7.5 lakh rupees. First of all, it's pretty lower than that, what we really, really need. But chalo, just for the argument purpose, let's take 7.5 lakhs. And let's say if nothing happens to us, all goes well, all hale and hearty, we get somewhere about 48 lakh rupees. I've just rounded it off to 50 lakh rupees. Okay. Now, here, if you want to calculate a profit per se, you're paying a total premium of 15 lakh rupees. You're getting 50 lakh rupees. You make a total profit of 35 lakh rupees, right? That's what you're saying. And that's what you're arguing with me, Akshat. In term insurance, we are continuously paying. We're not getting a single penny back. Let's look at that. Term insurance, I see, yes, somewhere about 20,000 rupees is what I'm paying. For the 30 years, I pay a total premium of 6 lakh rupees. If something happens, my family gets 2 crores. If nothing happens, I get zero money at all. I get nothing at all. Agreed. So you're saying, Akshat, 35 lakh versus nothing. And I am sure nothing will happen to me. I am all happy and healthy. I have been going for jogging every morning. Nothing can happen to me. That's what I want. Nothing should happen to any one of you. We should live till 110, 120. I aim to live till 125. Let's see if I can make it. But the point being, argument taken. How about I give you a smart strategy? In this smart strategy, what I'm suggesting you is you continue to buy a term plan, right? Because that's the only plan that could cover the basic necessity, the required sum assured that you have. You continue with the term plan. Now, when you were buying a ULIP or an endowment plan, you were paying 50,000. Against that, your term plan is just 20,000, right? There is a difference of 30,000 that you are saving on buying a term plan over an endowment plan. Why not invest this difference of 30,000 rupees into any index or any large cap mutual fund, right? And considering a 30-year time duration, our total investment becomes about 9 lakh rupees. We will be able to, if we are able to generate a 12% return, which over the span of 30 years from a long-term mutual fund is pretty achievable. We'll be able to create a corpus of 81 lakh rupees. This 81 lakh rupees not only covers the 6 lakh rupees of premium that we are paying, but it also covers the opportunity cost, if you may say so, that we would have, the opportunity of making 35 lakh from the ULIP plan. Getting my point? Just buying a term plan and investing the remaining money, whatever difference of premium was there, into equity mutual fund that gives you 12%. Chalo, let's not take 12%. Let's just take 10% to be more modest. It still gives you 54 lakh rupees additional, which is covering this money that you're paying plus this money. You're paying the same premium in that case, if you see, right? 15 lakhs and here's 6 lakhs plus 9 lakhs. You're still getting 54 lakhs. 10% is pretty achievable over a 30 years of time, and you cover everything that you were in the other way losing, right? And so my friends, I hope this was clear to you. The point that we wanted to make is all you need term insurance plan. All you need is a term insurance plan to cover your life. You do not need any endowment plan. You do not need any sort of ULIP plans or any XYZ plans that come into the market. Clear? Can I have a quick round of thumbs up if you are clear till now, if you're understanding till now? Can you have a quick round of thumbs up? I will take all of your questions. I'll take all of your questions. Perfect. Now, Another thing. Insurance companies have become smarter, right? And so they're saying, okay, now that people are understanding the importance of term insurance, what else can we do in order to get some more profit? Okay. Now, they might sometimes come to you saying that, Akshat, why do you want to pay regularly for the next 30 years? You're paying 20,000 per month, roughly about 6 lakh rupees in 30 years. Why don't you just pay it all off in 10 years itself? 42,000 over 10 years, you're paying 4,20,000, right? 20, I mean, just a little above double. But in total, you are paying 4,20,000. And then, over the next 10 years only, you will be done with your premium and you will still be covered till 60 years of age. Why do you want to continuously pay 20,000 rupees for the rest of the entire life? Inflation. First point, inflation. 20,000 rupees from today. 20,000 rupees of today, do you think 25, 30 years later will be of any value? 20,000 rupees for today, 25, 30 years later would be like peanuts. It will be like 1,000, 2,000, 3,000 rupees of today, right? The point being that considering inflation, if you are in a regular pay option, you are in a way paying a decreasing premium. This premium is not increasing. You are paying a decreasing premium considering inflation every year. Then why do you want to give an additional premium to the insurance company? Right? On the other hand, let's look at it from the mathematical standpoint again. Let's look at this calculation. 20,000 rupees is what we are paying in a regular pay option, right? And in a fixed pay option, it's somewhere about, in a 10-year option, it's somewhere about 43,000, right? 43,000 is what I've taken. And now you're saying, Akshat, in this case, I'm paying an additional 1,70,000. Once again, invest the difference. Even if you invest the difference for a 10-year period into any asset that gives you 8% return, and now 8% is achievable, right? Now these even FDs have started giving 6.5, 7% return. 8% is achievable. 3.5 lakh rupees, 3,60,000 rupees is what you make. Chalo, 8 bhi nahi, let's just consider this as 6%. 3,21,000 is what you make. You will be able to again cover for this additional payout that you are thinking you are paying in terms of the regular pay, right? So once again, you do not need to do that. All you need is a regular pay option. Please do not fall for this trap, this limited pay, this, that, etc. Not required. Okay. Third point. Now, companies also say that, Akshat, the probability of something happening to you in 60, 65 years of age is very low. Why don't you cover yourself till 99 years of age? Because something happening to us in 80s and 90s, the probability is much more, right? Then why just cover yourself till 60, 65? Why not till 90, 95, 100, 99-year plans have also started coming? Tell me one thing. You buy insurance when you are the primary or the secondary bread earner of the family. When you are 80 years old, will you be the primary or the secondary bread earner of the family? You will be relaxing on some island, sitting with your wife and, just enjoying the beach there, right? I mean, your children at that time are going to be grown. They'll be self-sufficient. You don't have to be worrying about them. At the same time, you are not really, nobody is dependent on you at that point of time. And fortunately, hopefully, you would have invested all of this money with all the strategies that we've been teaching and created enough wealth for yourself to successfully live your rest of your retirement days as well as take care of your children. The point being, once again, in order to cover myself, let's say for 50 years or for 80 years, let me go with a 50-year term, right? This money, regular pay, right? This premium from 20,000 rupees jumps up to be almost 32,000 rupees. 12,000 rupees extra is what I'll have to pay the premium company from the insurance company from today. Not required again. Invest this 12,000 rupees. You know the strategy now, right? So the point being that you need to buy only a plain vanilla product when it comes to term insurance for your covering your life. There are tons and thousands of products out there. You don't need any. All you need is a simple term insurance policy covering yourself till 60, 65, or chalo max to max 70 years of age. If you think that you'll have some dependency till then, 70 years of age with a regular pay option. That's it. That's it, folks. That's it when it comes to term insurance. Put this down in your notebooks, write this down in capitals. All you need when it comes to term insurance is a simple, plain term insurance plan with a regular pay option till 60, 65, or max to max 70 years of age. Period. Make sense? Did you all get it? Do you all understand that? Can I once again have a quick round of yeses in the chat if this made sense to you, if you all agree to me? Yes? Perfect. Perfect. I think few of you are responding to the host and panelists. Just maybe change the drop down to everyone so that everyone can see your responses, right? So yes, I know for those of you who've been paying your premiums over the last 5-10 years, this might be surprising, but I'd also suggest for those of you who've just recently started paying your ULIP or endowment plans, please look at it. Sometimes it's okay to let go of a couple of premiums that you've paid. Let's say if there's 2 or 3 premiums that you've paid so far. I know it's in a way very tough to let go of something that we've invested our money in, but trust me, if you mathematically calculate, stopping that that insurance and infusing that money to invest, buy a term insurance and invest it into another mutual fund or so would give you much better returns and would in fact help you cover these losses in the long term as well. Okay, so please recheck all of your policies. We'll share a couple of POCs at the end of the session today, whom you can actually reach out to and work through this on a one-on-one basis. But yeah, I'll come to that to talk to you about it, right? But for now, I hope this makes sense. With respect to life insurance, all you need is a term insurance plan with a limited pay, with a regular pay option up to 60, 65, or max 70 years of age, right? And that's why we say never mix insurance with investing. All of this problem comes, the way it is structured, right? All of this problem comes when we start considering insurance as an investment. We start paying our premiums with the thought that I will start getting something back from my insurance policy after 10 years, 15 years, so on and so forth. No. Insurance is not an investment. Just like we buy a mobile phone to make calls, we buy a laptop to surf, we buy a car to drive around, we buy food to eat, we buy a home to live. Similarly, we are buying an insurance to protect ourselves. We are not investing into insurance. We are buying an insurance in order to protect ourselves. Completely delete the word insurance and investment together. Both are two separate things, right? And once you get this clarity, trust me, you will never make this mistake, right? So do not mix insurance with investing. Keep your insurance separate. It's an expense. It's a product that you've bought, just like you've bought other additional things. However, investments are investments which are separate. Okay. Now, I know these days, some additional policies have started coming up, something like guaranteed income, fixed guaranteed income for your retirement, for your child plans, for this and that, so on and so forth. And this is somewhere, I hope this is visible enough. The policies read out something like, all you've got to do is pay 2.5 lakhs per year for the next 10 years, wait for 1 year, and then you start getting 4.85 lakhs over the next 10 years. So which means for the first 10 years, you're paying about 25 lakhs. Over the next 20 years or after 20 years in total, you'll get about 48-50 lakh rupees back. And you'll be like, wow, I've doubled my money over a span of 20 years. How cool is this? On the other hand, policies like pay 2.5 lakh for 10 years, wait for a year, get 6.33 lakhs for the next 7 years. In fact, the last one, pay 2.5 lakhs for 10 years, wait for a year and get 8.35 lakhs over the next 5 years. Wow, 40 lakhs over the next 5 years. How cool is this? And then to top it up with all of this, we put in they put in tax saving, they put in guaranteed income, this, that, etc. Right? Life insurance as well. Now, coming back to calculations, right? Now that you learn about it, we do not take any decisions when it comes to money without calculating on an Excel sheet. And so what we've done is we've replicated each of those plans that you saw in the presentation on this Excel. So the first plan, let's concentrate here on the column D, right? It says pay 2.5 lakhs per year for the next 10 years, right? So that's where you say we are paying 2.5 lakhs per year for the next 10 years. We take a break and then you start getting 4.85 lakhs every year for the next subsequent 10 years. If you calculate, the return percentage comes out to be only 6.21%. Tell me honestly, 20 years, 6.21%. Now you know about mutual funds. Now you know about investments. Is this justified? 20-year period, 6.21% interest. Is it justified? On the other hand, this second plan where you get 6.33 lakhs, the interest comes out to be only 6.12%. This last plan where we were going crazy, 8.5 lakh rupees, 40 lakhs over the next 5 years, least rate of interest, 6.08% is what it comes out to be. No point. On the other hand, just to give you that comparison, that same sort of a thing, let's say, now you say, no, Akshat, I'm getting that 485 back. I need it, at that time, it'll be helpful for me. I'll be starting my retirement date, so on and so forth. Okay. Let's replicate that same plan into a mutual fund plan. Let's invest, or mutual fund or any other investment that gives you a 10% return, right? Don't think that I am only focusing on mutual funds. I feel personally mutual funds are a great way to passively invest. But yeah, you can definitely look at other opportunities as well. But the point being, let's replicate that same plan, right? So we are investing 2.5 lakh rupees, paying 2.5 lakh rupees for the first 10 years, taking a break for the 11th year, and 12th year onwards, we are withdrawing 4,85,000 from that mutual fund. The assumption that we've taken is over a span of 20 years, the mutual fund gives you a 10% return, which again is pretty much doable, right? Now, you see, even after considering this amount of 485 that is getting credited into your bank account, the total amount, you have about 36 lakh rupees extra left. 36 lakh rupees left in with you, even after withdrawing that 4,85,000 rupees continuously. Replicating that same guaranteed money back plan. This 36 lakh rupees is left for you, right? And this, in a way, if you would have checked, this would be the profits that the insurance company would be earning in order to, get you these returns. They obviously would be investing the same money elsewhere to generate 10, 12, even 15% returns. And that being said, why do you want to make the wealth compound for them and not compound for you when you have these options right in front of you, right? So that is what it is. Once again, I wanted to cover this just to give you an idea of what kind of things that could come up. I've seen people, once again, making a lot of mistakes even after attending the session. So please don't. All you need is a term insurance plan with a limited pay option. Sorry. All you need is a term insurance plan with a regular pay option up to 60, 65, or max 70 years of age. Can someone put that in the chat for me? Term insurance, plain vanilla product. All you need is to buy a term insurance from any of the companies out there, and to talk more about it, we'll let you know in the end. But all you need is a term insurance plan with a regular pay option up to 60, 65, or max 70 years of age. Make sense? Yes, no? Who's putting that in the chat for me? Yeah. Okay. Perfect. Cool. Okay, so now that we've learned about life insurance, I'll maybe give you a break for a minute, and in fact, I'll also take a quick 1 minute break. I'll be right back, but just take a moment to just sit down and absorb whatever I've shared, right? And then we'll start health insurance. Just take 1 minute, sit and absorb whatever we've told you about term insurance, life insurance. I know those calculations could be a little tough to understand at the first go, but maybe just absorb that for a minute. Quickly go through your notes if you've taken, and yes, if you have any questions, put them down because then we can take them at the end of the session. Once I'm back, we'll start with health insurance. Okay, I'll be right back in just a minute.
Hi, Akshat. We have a question in the chat box if you might want to take it.
Sure. Whether any comparison needed for taking term insurance, as there is an IRDA rule for not rejecting a term insurance which is in force for more than three or more years. Okay, so Amal, I think I think the rule pretty much states, but that also comes with a fine lining that provided that the person has given all the correct information and nobody is there to challenge it. Now, what I'd suggest is definitely we can talk about comparisons, and there are a few folks from Ethika who could help us look into the features of various policies. However, one thing that I'd want to mention here is when you're buying a term plan, right? Just be very, very truthful in your application form, right? Whether you smoke, whether you drink, please declare it. Do not hide that information. Term insurance companies or insurance companies are looking for the slightest defect, if I may say so, or slightest misinformation that you might have quoted while you were buying that insurance in order to reject your claim. So please be very, very sure that that you declared everything correctly, and at the same time do check out the claim settlement ratio, right? For companies that have less than 97-98% of claim settlement ratio, I don't think it makes sense. Right, so maybe you can put the first filter on companies that are only offering you that have a claim settlement ratio of 98% and above, and then yes, there are a couple of other parameters too that you can check when you are comparing policies by the various plans. Yeah. Okay. Feel free to keep putting your questions in the chat, and we will definitely come back to it at the end of the session. In the time being, I'll proceed with the next big aspect of insurances when it comes to health insurances, right? So, okay, let me begin. And health insurance, pretty much self-explanatory. Insurance that we need in order to safeguard our health. Something happens to us, some sort of an hospitalization happens, right? We have to make sure that we are financially covered. We do not get into the financial burden of when it comes to hospital expenses, right? So key terms that we all must check when buying a health insurance. These are a few of the key terms. I'll go through them. The first one, a co-payment. Now, what is a co-payment? A co-payment states, let's say if it's a 10% co-payment, for example, the co-payment states that once the hospital bill comes, right, you're admitted and hospital bill comes, the first 10%, 15%, whatever is the co-payment clause, has to first be paid out of your pocket, out of the patient's or the patient's family pocket, right? Let's say if it's a 2 lakh rupee bill, the first 20,000 has to be paid by you. And then the insurance company will pay the remaining to the hospital. Okay. So that's what a co-payment means. There are plans out there which come with a zero co-payment. I'd suggest, if the difference in premium is not much, go for a plan which has zero co-payment, so that at that point of time you don't have to really struggle on paying something out of your pocket. Everything gets taken care by the insurance company itself. Okay. Second, very important, sublimits. Now, I'll give you an example, right? What happens is, I actually know of a very close friend whose father was getting admitted for a surgery, for a 10-day long, surgery. And then he was like, I really want my father to stay in a private room, maybe a little upscale room, and not stay in the general ward, so on and so forth. And he said, I have a 5 lakh policy cover. The room rent, what they're saying for that is 20,000 per day. So 20,000 into 10 days is 2 lakh plus some additional, I think 5 lakh rupees ke andar, it will get covered. Okay. Now the point is that there is a sub-limit based on your maximum insurance policy on each and every feature, right? So for example, there could be something called as a room capping, wherein although you have a total of 5 lakh policy, however, you are not entitled to go beyond a 5,000 or a 10,000 room rent per day. So in that case, even if you have a maximum of 5 lakh of cover, your policy will still pay you just 1 lakh rupees, because 10,000 rupees is what was the capping on the room rent, right? Similarly, based on this, there are other cappings as well, on medicines, on surgery types, so on and so forth. So be very sure that you read through all of such cappings and what's the sublimits on each of the features that are available. Based on your room rent on pro rata basis, the other things are also calculated, right? So you have to be very, very careful reading through the sublimits of what that insurance plan has to offer. As obvious as it may sound, go for an insurance plan that has the least has sublimits on the least number of items, and also has a good sublimit for each of the items that you might really need, right? Third, waiting period. Now, waiting period is something. So, for example, let's say while I was buying an insurance, I declared that I have a heart condition, right? Maybe I have some issues. I've had some issues related to heart in the past. And so it is very, very important to declare all of this. This is known as pre-existing condition. Whatever pre-existing conditions one must have, they must declare it while they're buying the insurance. Now, a waiting period means that after buying the insurance, let's say if the waiting period is, for example, 3 years, then after buying the insurance, for the first 3 years, my insurance company, if there is, if the admission in hospital is because of a pre-existing condition. Okay, so for the first 3 years, in case I get admitted to a hospital for a pre-existing condition that I had before buying the insurance company will not pay any money, right? Because that's a pre-existing condition, and within the first 3 years is once again I fell ill because of that, and I have to now get admitted. So at that time, your insurance company will not pay any amount. That's called a waiting period. Okay, so waiting period ranges once again from 2 to 3 to 4 years. I guess there are policies that are offering as low as 1 year's waiting period, and then waiting period also depends on the different kinds of diseases. I think for COVID disease, it ranges from 7 to 14 days, so on and so forth. Right. So waiting period is something that once again you must check. You should have a waiting period as less as possible on your policy. Next, pre and post hospitalization charges. As we know, doctors sometimes recommend us to get a number of number of tests and things done before we get hospitalized for a surgery. And then even after that, post the surgery is done, there could be follow-ups, checkups, some tests again. So there are insurance policies that cover both your pre-existing as well as post hospitalization charges. Go for the insurance company that covers this for the maximum period of time. Next up is the restoration benefit. Now, what does restoration benefit mean? Let's say you had a 5 lakh rupees of policy cover. That was your base insurance plan. Now, you got admitted into the hospital maybe once or maybe subsequent times over a year, right? And then because of that continuous hospitalization, you exhausted your minimum base package, right? So you've exhausted your 5 lakh rupees. Now, few of the policies have a restoration benefit, and what they would do is they would restore your base amount once again, right? So let's say within a year itself, if there are multiple hospitalizations that you have to do, then once you've exhausted your initial limit, for example, of say 5 lakh rupees, policies that have a restoration benefit would restore your policy back to the same amount of the base plan, right? So you'll get additional 5 lakh rupees in case of multiple hospitalization. So your subsequent hospitalization can also get covered from the additional base plan. Okay, so it's not an additional base plan, but more of a restore, right? You understand the concept. So you're basically restoring your base plan and adding another 5 lakh rupees to it, right? So go for policies that do offer that restoration benefit. Next is a no claim bonus. So no claim bonus once again is something for all the hearty and healthy people who make sure they're doing really well. The insurance company wants to treat them right, because obviously they're paying the premiums but not taking claims, and that's what make everyone happy. That's what make everyone happy. So that's why the insurance companies offer no claim bonus. It's generally in the form of reduction of premiums or maximum cases, they increase your sum insured. So if, let's say, if it's 5 lakhs for the first year, there was no claim, it might go up to 5.5 lakhs. Next year, it might go up to 6 lakhs, so on and so forth, right? So go for a policy that has that gives you the best no claim bonus. And finally, exclusions. Exclusions is something that you should just check through, right? A lot of policies do not cover, for example, ambulance charges, pregnancy charges, or maybe something related to particular diseases. So make sure you buy a policy that has as low exclusions as possible, and things that you definitely need. If they are not there, then that's something which you should check for. Cool. So these are a few of the key terms which you must check, which you must go through, and whomsoever you bind the policy from, you must ask them questions on these key terms as to what is the co-payment, what is the waiting period, so on and so forth. Clear? Now, as Shiva was also sharing in the beginning, and I too have seen some of the cases during the COVID time. Not to scare you, but just to make you aware, these are some of the sample bills of patients during or prior to the COVID time, wherein they saw bills as big as 53 lakh rupees, 20 lakh rupees, so on and so forth. Now, even after having an insurance, and let's say you buy an insurance and then further buy an insurance, even if, let's say, your company is covering you for one, these bills are huge. These bills are huge. And yes, people had to sell off their properties and, maybe arrange from money from here, there, and everywhere in order to just pay these bills. And so I know, I hope it never happens to us, but we've got to be prepared for all emergencies. And so just so that this does not happen to us, and we are not in a condition that if in case a huge bill comes up, we are not able to pay that bill, there is something called as a top-up and a super top-up plan. A top-up and a super top-up plan. A top-up and a super top-up plan are added to your base policies and kick in once you've exhausted your base plan in a certain fashion, right? I'll just come to that as to how both of these work and which one is the better of both of these. Also, I do want to mention that they are not very expensive, right? So if you see, there's this one random example that I've taken up, and the base cover is 5 lakh rupees, right? That comes out to be somewhere about 8,000 rupees annually. On the same hand, an additional cover of 95, right? So total going up to 1 crore, which means this has base of 5 lakhs and a top up of 95 lakhs, goes only about 1,600, 1,700 rupees additional annually, right? So it's not much of a difference, but it is very, very useful when it comes to paying for these large claims. Okay. So I'll take you through some of the scenarios as to how does top up and super top up work. If you have any questions, feel free to stop me and ask me questions, because this could be a bit confusing, but at the same time, I'll try to make it as easy and as understandable as possible. Okay. Now, assuming a scenario that you have a base plan policy of 5 lakh rupees, a top up, super top up, you can get either one of these. So a top up or a super top up of 20 lakh rupees and a deductible of 3 lakh rupees. Okay. Now, first and foremost, what is a deductible? A deductible is something that you have to first pay out of your pocket. You have to first pay a deductible out of your pocket, and only once you pay that will your top up or super top up plan kick in. Okay. Your deductible has to be something that has to be paid upfront from your pocket, and only then will your top up or super top up plan kick in, post that you've exhausted your base plan. Okay. Now let's look at some scenarios. These are definitely useful for people who have chronic conditions, or who foresee multiple admissions during a year. So we've taken two scenarios. Let's focus on the scenario A first, right? Let's say during a year itself, there were 4 hospitalizations. Okay. So during the year, the first bill amount came up to be about 4 lakh rupees. Now you have a base plan of 5 lakh rupees. So yes, 4 lakh rupee bill amount would get fully covered by your insurance, minus the co-payments or whatsoever, but it gets fully covered by your insurance. And since, it's covered by your base insurance, your top up and super top up basically do not kick in. It's not even required at that point of time, right? Then in the same year, you had another hospitalization, which came up to be somewhere about 1 lakh rupees. Once again, you have an additional, you had 5 lakh rupees of base cover, 4 lakhs is covered. Another 1 lakh will also once again get covered from your base plan, and you don't really have to worry, and your top up and super top up once again do not kick in, right? Third, now you've exhausted your base plan, right? The 5 lakh rupees is gone. You once again had to get admitted to the hospital, and 2 lakh rupees is off the bill. Now, is it going to be covered by the base plan? No, it will not be. However, is it going to be covered with your top-up plan? So in this case, no. Your top-up plan will not cover. Top-up plan has a condition that a top-up plan would only kick in if the individual bill is over and above your base plan. A top-up plan will only kick in if an individual bill is over and above your base plan. Okay, so since it's a 2 lakh, it's not above 5 lakh rupees in total bill, so your top up will not kick in. However, your super top up policy will kick in. If you had a super top up instead of a top up, your super top up would kick in. However, since you have a deductible of 3 lakh rupees, so you will have to first pay an amount equivalent to this 3 lakh rupees from your pocket, and then only will your super top up plan pay. Okay, so in this case, 2 lakh is the bill amount, right? So this 2 lakh has to be paid by you as the policy holder. Okay, now considering the same year there had to be a fourth hospitalization, which amounts to be 3 lakh. Obviously, your base plan is not covering. Your top-up plan still did not kick in because it did not go over your 5 lakh rupees of base plan. However, this time your super top-up plan will kick in. You will have to first pay an additional 1 lakh rupees because your total deductible is 3 lakh. You've paid 2 lakh previously. 1 lakh addition is what you have to pay, but the remaining 2 lakh rupees is something that your super top-up plan will pay. Okay. Did you get how it works? A top-up plan only kicks in once your original bill is above the base plan. Your super top-up does not have such condition. It will kick in as soon as you're done paying your deductible. Another difference is in your top-up plan, you have to pay this. Your deductible gets reset every time. So every time you get the bill, you'll have to first pay your deductible. Only then will your top-up plan kick. In super top-up, you see the deductible is calculated in total. I'll cover this in the second scenario. In second scenario, if you see here, let's say the first bill was 6 lakh rupees, right? So now in this case, your base plan is only of 5 lakh rupees. So it covers partially up to 6 lakh rupees, up to 5 lakh rupees, and 1 lakh of additional is left. Now your top up will kick in because the initial amount is above your base plan, which is 5 lakh, but deductible has to be paid out first. So 1 lakh rupees of deductible again goes out from your pocket. And similarly with your super top up, your deductible has to go in first. You have to meet the 3 lakh rupees of deductible. So your 1 lakh rupees of money has to go out from your pocket, right? In the first hospitalization in both the cases. Second, let's say in the same year, there's a second hospitalization. Now it's a 3 lakh rupee bill. Your base plan is obviously exhausted, right? You do not have any additional cover. This top up will not kick in since your base amount, since the bill is not more than your base amount, right? You had a 5 lakh rupee base amount. It's not more than that. So your top up will not kick in. However, your super top up will kick in. And how will it kick in? That you will have to first finish that 3 lakh rupees of deductible. So 2 lakh rupees have to be paid by you by your own, from your out of your pocket. So sorry for that. And the remaining 1 lakh is then is something that will be paid out directly by your super top up policy, right? So in the first and the second hospitalization, you've covered the 3 lakh rupees of super top up deductible, right? And now let's say there was a third hospitalization, and this time it was a very, very hefty amount, a 9 lakh rupee amount, right? So your cover by base plan is exhausted. In terms of a top-up plan, as I said, the deductible has to be paid every time. So you'll have to first pay the 3 lakh rupee deductible and then get a 6 lakh rupee top-up, right? Only then will the top-up click. Sorry, there's an extra zero. Only then will the top-up click. Only then will the top-up kick in, right? So you're basically paying a lot additional from your pocket. However, in your super top up, since you've already paid deductible, adding to 3 lakhs for your first two hospitalizations, you don't have to pay anything from your pocket. The entire 9 lakh rupees will be taken care of by the super top up plan, right? And let's say if there's once again a fourth hospitalization in the same case, which again amounts up to 6 lakh rupees, your base plan is exhausted. In a top-up plan, it does kick in, but once again, a 3 lakh of deductible first by your own pocket and then a 3 lakh rupees of top-up. You see, overall, you've already paid out 7 lakh rupees in this top-up plan, even after having a top-up. So that's why it doesn't really make sense. However, in a super top-up, this entire 6 lakh rupees will come directly from the insurance company. Clear? I hope these scenarios gave you some clarity. Yes, I hope such kind of recurring hospitalization never happens with any one of us, but it's always good to be prepared, right? And so you must make sure that you buy a super top-up plan. That's why I say a super top-up plan is something which is better than a top-up and is very, very useful, right? Where will be the deductible information present? It'll be there. Okay, so when you're buying that plan, right? At that time, I'll just share that with you. So when you're buying that plan, okay, let me actually share that with you right now itself. So when you're buying that plan, at that time, you can discuss it with your agent, the person who's selling you that plan. And for example, I think we took some numbers here. Oh shit, did I? Oh yeah, we have it here, right? So for example, if you see, these are just some of the numbers that are there, right? So for buying a super top-up plan, which has a sum assured of 15 lakh rupees and comes with a 3 lakh deductible, you only have to pay 4,400 rupees. This is the amount if you're buying a family floater plan, right? So 2 adult plus 2 child, 4,400 rupees is what you're paying for a 3 lakh deductible. Similarly, let's say if you are increasing your deductible to 5 lakh rupees, sum insured is 25 lakh rupees, 3,973 rupees is what you are paying in addition to your insurance premium of your base plan. This is again for your entire family. And let's say, you feel it's better to go for the entire 50 lakh amount. First of all, it's for the entire family. And then, it's better you take for that. So all you pay is just 1,000 rupees extra in premium. However, you have a 10 lakh rupee deductible, right? So in that case, 10 lakh rupees is what you'll have to pay from your pocket first, and only then with the insurance company pay. This is also advisable if you have a big family and you're staying in a metropolitan. The 10 lakh deductible, generally most of us have insurance policies from our offices, right? So maybe about 5-7 lakh rupees is what we get the annual the general coverage. We can get that money, use that to pay the deductible, and the remaining 2-3 lakh rupees is something that we can take from can arrange, right? Something that's an amount that can be arranged through our network, through our circle, through our savings, so on and so forth, right? And similarly, this is just for 2 adults, right? These are some of the prices there as well. You could accordingly go about it, right? So this is for adults aging 31 to 35 years, right? So these are just some rough numbers to give you an idea on how these things work. The main difference I wanted to point out between a top-up and a super top-up is a top-up will kick in only when the hospital bill crosses the amount of your base plan. However, there is no such condition in a super top-up plan. So yes, it is advisable to go for a super top-up over a top-up, right? That was the main benefit of it. Two major benefits: the base, the condition of the bill going above the base policy is not there, and secondly, you don't have to pay the recurring deductible as well. All you've got to do is just pay off your deductible once, and then the super top-up will take care of all the needs. Clear? Okay. Few additional things to remember while you're buying super top-ups. Super top-up plans also might have rent limits and other limits, so definitely check on that, right? What kind of room rent or what kind of capping is given there. Waiting period might be different for both policies. So your base plan might have, let's say, a 3-year policy, but your super top-up might have a 4-year policy. I'm just saying. So make sure that both of those go hand in hand. If your super top-up, if your base plan has a 3-year waiting period, super top-up should also have a 3-year plan, right? Top-up plans can be from 2 different insurance companies too. Let's say, I'm just randomly saying, right? Let's say you buy a base health plan from a Bajaj insurance policy and a top up from a Tata policy, that is also doable. But it is not very, very advisable. Why? Because at the time of filing the claim, you'll have to do two separate paperwork, coordination with two different companies. At that time, you don't want to get into the all such hassles, right? So the suggestion is to be, better take it from one insurance company itself. If the premiums do justice to it. Yeah, if the premiums have huge difference, then definitely you can consult an agent and see what best can be done. But unless and until there's not too much of difference between the premiums, it's better to stay with the same company. Okay. Super top-up plans are much cheaper. So instead of thinking that, let me go for a 20 lakh rupee base cover or a 15 lakh rupee base cover, you should always try for a 5 lakh, 7 lakh rupee base cover and get a additional super top-up. That definitely helps. Right? These are a few of the things that we wanted you to remember, and definitely take a note of it. So having said that, 2 insurances are a must for everyone: a term insurance to cover your life and a medical insurance to cover your medical emergencies, right? These are the only 2 insurances that you absolutely need. Above this, if you have some money, give it to me. I promise you I'll give you good returns. Just kidding. But the point being, when it comes to insurance plans, these are the only 2 insurances you need. Please do not fall into trap by buying any other insurances that are available in the market. Okay. See, this is what happens when your client says they'll buy the term and invest the difference. The agents do not like it. And I just want to mention, right? I mean, I've talked about agents a lot, and personally, no hard feelings against them, right? They are just doing their job. Insurance as an overall industry is structured in such a way that it's a very sales-oriented industry. So unless and until you don't sell, they won't be able to earn commissions. They won't be able to run their homes, right? So not blaming any of the agents out there. They are hired and trained in such a fashion that I'm sure even most of them don't understand the mathematics and the calculations behind it, what we've covered today, right? So I really don't have any hard feelings against them. It's just that, sometimes some of them become too pushy on making us buy a particular product, which we absolutely don't need. So, next time, please do run through all of these points with your agent and make sure that you are taking an informed decision, right? Okay. And yes, another important aspect, I already have a company insurance. Should I go for one? Should I not go for one? A very common question that we are asked. No, we should not just be dependent on your company's insurance. What if you leave the company and you join a company that does not cover your health insurance or your life insurance? And in fact, even if it covers the plans or the group benefits or so on and so forth are not enough, right? So having said that, it's okay. I mean, it's good to have insurance from your company, but you should definitely have one of your own. When it comes to claiming, you can claim the one from your claim from your company's insurance first and then from your personal insurance. But it's always good to have an insurance of your own. Say you want to leave your job, say you want to do a startup, you want to do something of your own, so on and so forth. So it is very, very important, right? I waited to buy a life insurance and now I cannot afford it. I've heard it from a number of people, and trust me, I'm not joking here. My parents are in the same boat, right? Now they are 60, so 60 plus. So, they never bought a life insurance. I mean, they too bought insurances like ULIP, LICs, and so on and so forth, but it was also not of any use to them, right? But having said that, if today I want to go and buy a term insurance for them, I'll have to pay a bombshell, which is definitely not something that I think I can afford. The point being that, as they say, you should invest your money as soon as you start earning, maybe 18 years, maybe 20 years of age, so on and so forth. But when it comes to insurances, what I personally suggest is once you're about to be the primary or the secondary bread earner of the family, that's when you should go ahead and buy an insurance, right? 25 to 30 years, I'd say, is an adequate age. You're single right now, about to get married in a year or so, extend your family, have dependents. So that is the time when you can kick in, start your insurance journey. Maybe start, let's say, at the beginning, you want to start with say 50 lakh rupee insurance plan, right? When it comes to term plan, right? It's possible to buy multiple term plans as well. So right now you're single, you think you don't have too many of liabilities, maybe just go with a 50 lakh or a 1 crore term plan. Couple of years later, once you see liabilities have increased, once you see responsibilities and dependencies have increased, maybe you can buy another 1 crore of term plan, right? So that's how you have to think about it. It is, I mean, don't wait till your 30s or 40s or 50s to buy a health insurance or a term insurance. Buy it as soon as possible. But yeah, 25 to 30 is generally the right age to get yourself enrolled in both a term insurance as well as a health insurance. Okay. And yes, since we are here and Ethika already excels in helping people buy the right insurance product, these are two numbers. You can quickly take a screenshot. They will be more than happy. They're there from the Ethika team, so they'll be more than happy to help you choose the right plan for yourself. Even after all the concepts I've taught, there could be many other things that are there when you practically go and select policies. Right, and there are tons and tons of insurance providers out there. So which one is doing good, which one is doing not doing good? You know, all such things is what you can question with Shifa as well as Puneet, right? So maybe you can take a screenshot. We'll also paste these numbers in the chat. You can reach out to them for any sort of discussions you want to do with them. Okay. Having said that, there is, yeah, I mean, that's almost that I've completed. We'll just do a quick case study and then, you know, just to make sure you've understood everything. And then, you know, we'll be open to Q&A. And I know Sharath also wants to add on a few points. So we'll just quickly do the case study and then move on to the other things for this session.
Akshat, can you just go back to the contact slide? There's someone who's asking for those numbers.
Oh, sure. Do you want me to paste them in the chat? I'll do that. Okay. Most welcome. So let's quickly do the case study and then we have another round of information for you, something which is very, very important. Let's quickly do this case study. Okay. So Mr. Abhinav, aged 27 years, is expecting a baby next month. His investments are mutual funds for a goal which is 14 years from now, and FD worth 1 lakh to meet their emergency needs. He doesn't have a life insurance, nor is he confident on having it. Now, you being his advisor, now that you've learned everything about insurances, let's consider you are his advisor. Question number 1, would you recommend him to have a term life insurance? And if yes, why? If no, why? Shall he use his personal medical insurance or the one provided by his company next month for the hospital expenses? Or third question is, should he break his FD or his mutual fund investments if required next month? You've got to answer each of these 3 questions, put them in the chat. We'll quickly check a couple of answers and then I'll give you the final answer against it. So some of you are saying 1 or 2. What I'm saying is you'll have to answer each of the 3 questions, right? So you have to, yes. So Vasu has given his, submitted his answer. Vasu says yes, as he's being the primary bread earner. Use a company insurance, break FD is if not other options. Harita says yes, I do recommend to have a term insurance. If anything unfortunate happens, it'll be baby. It'll help the baby's future. Yes, because a dependent is going to be added. Great answers. Let's wait for a couple of more. Okay, yes, to secure future of dependents. Personal medical insurance, yes, break his FD as compounding returns will be good in mutual funds. Okay, perfect answers. Just a little bit of mistake on the second one, but I think most of you got it. Yes, absolutely, very important to buy a term insurance because he now has more dependents. Second, shall he use his personal medical insurance or the one provided by his company? Take the one provided by the company, right? Why do you want to use your personal medical insurance? You can get your no claim bonus for your personal one and get additional benefits for that, right? So use your company's insurance first and then use your personal one if required. And should he break his FD or mutual fund? He should definitely break his FD because he's investing in mutual fund for a long-term goal. and you don't want to disturb your long-term goals for your urgent needs, right? So that is something that can be taken care by the fixed deposit. Great. Wonderful. Wonderful. With that, I'd hand it over to Mr. Sarad, and then post that, there are a couple of activities that I'd love to do. So over to you,
Thank you. Thank
Sarad.
you so much, Akshat. Thank you all the participants for the wonderful participation. We have our co-founder Sharath who wants to speak a couple of words. He's been in the insurance industry for the last 15 years. He's seen all of it. So, Sharath, any kind words, please?
Yeah. Hi, good evening, all. One point I would like to add, whatever Akshat has covered, it was fantastic. The one common question that when I also interact with a lot of my friends and my childhood classmates, all these things, the question that they ask is, when you invest in mutual funds or investments or FDs, you get returns. But by doing the health insurance or life insurance, I don't get any returns. So why should I invest? I always used to answer it in a natural way that, see, this is the only place that you invest money, and at the same time, you also pray the God that nothing should happen, right? In cricket and all, when you bet, you pray the God that wherever you betted, that particular team should win, and so you get the returns. But in health and life insurance, you invest, and at the same time, you also ask the God not to do anything. Reason because if you're expecting returns in these two policies, something should happen to the person, right? That is one reason that we don't expect anything to happen here. And other logic that I apply is, today, even if you're spending 10,000 rupees or 20,000, let's assume you're paying 10,000 rupees premium towards the health insurance, considering that you're getting a 5 lakhs cover. Now, this 10,000 rupees, every year that you invest, how many years will take to reach 5 lakhs cover? Right. So say approximately how many years? If you are paying 10,000 each year for 10 years, you'll pay 1 lakh, right? That means 50 years. Now, can you guarantee that you will be healthy in the next 50 years? We can't. Same thing happens with life. These are the two unfortunate events that we cannot measure. That is the only reason I say, instead of asking or using your 5 lakh savings amount, assume that you are parking 10,000 rupees every year with insurer, and you will be taking it at any point of time in the coming 50 years, interest-free amount. That's the only point I would like to add.
Yeah. Thank you so much, Sharath, for that information. Very, very useful. Akshat, over to you. And in the meanwhile, I'm going to post a poll in front of you. Please give us your valuable feedback. What do you think of the session? This will help me get more topics, get more speakers like Akshat himself to come and do a lot of other sessions going forward. And also it will boost Akshat's confidence to sort of do a lot of more sessions in a day like this.
Absolutely. So thank you, Sarad, for adding those 2 points. Definitely, something that I also kind of a different perspective for me as well. Especially the second point that you made. It is just like parking some additional money into a security which is absolutely accessible to you at any point of time, right? So wonderful perspective. Thank you so much for adding that.
Thank you.
Okay, so I'll take the session back, and there's just a couple of things that I wanted to quickly do, and then we'll be open to all your questions and answers. What we've done is, for those of you who've been attending these sessions, now we've covered a lot of them, right? This was the third session of the series. We've covered a lot of them, and so just so that you don't really sit on it and actually implement all of these activities or all of these learnings that we've done, there is an execution plan that we've prepared for you, right? And if I may say, execution, I believe, is the most undervalued superpower, right? Execution is something that even if you just get started with doing, it will give you so much clarity, right? Unless and until today, I'm sure before this session, even when you would be discussing with your friends and family, these kind of things wouldn't be coming on top of your head, right? Should I go for a term plan? Should I go for a medical insurance? So on and so forth. But after attending the session, I'm sure it's given you some understanding. And now once you go and start applying these learnings, there'll be tons and tons of other things that would come up to your mind, and you'll start wanting to learn about it. I mean, If required, give Shiva and Puneet calls at least 10 times a day just to get the right understanding and the right knowledge. Because only once you do that, you'll be able to take an informed decision. So having said that, what we've done is we've prepared a financial health scorecard for yourself, right? This is something that will help you stay on top of your finances and make sure that you are on your step towards financial freedom. What it says is, for those of you who attended our first session, you know about effective budgeting and how the 3 bank account strategy helps. So the 3 bank account strategy states that you should have 3 separate accounts for your savings, investments, as well as expenses, and you should club it with the 30-20-50 rule, or whatsoever is suitable to you. If you've done that, give yourself yes and give yourself a point. If you've bought a term life insurance, which is number 2 on the priority list, if you've bought a term life insurance, great, say yes and give yourself a point. You've bought a medical insurance, say yes, give yourself a point. If you've created an emergency fund, give yes, give another point. Define 3 short-term goals, define 3 long-term goals, plan for your post-retirement income, and finally start investing. We'll cover the post-retirement income and similar details in the subsequent sessions, but finally, start investing. The point being that these 8 points is what we feel are the perfect scorecard checklist for you. I'd say give yourself a point each for everything that you say yes to. If you are anywhere above 5, great. I'd say thumbs up. You are on your road towards financial freedom. Try to make it 8 on 8 as soon as possible. However, if you're 3 and below, it's something that you should be super, super alert about. If it's high time you take an action on it, please, please, please do not wait for anything else, right? So having said that, that's your checklist, so that you're able to check mark on every item that you cover with respect to your financial health. Cool. So yes, that was the financial health scorecard that I wanted to share with all of you. We'll definitely share these slides with Shiva, and Shiva will circulate it around with all of you guys so that you can take care of it. A quick LinkedIn activity. So just like you've given your responses on the poll, I'd love if you could give me some of your unique key takeaways, on this LinkedIn post as well, right? So I've just posted about this amazing experience that I've had with all of you doing and facilitating this session. If you could take out just 2 minutes of your time, if you could take them out right now and give me a comment on what was your unique takeaway from this session, what was your unique learning from this session, it would really, really, really mean a lot to us, right? Our entire team goes on and goes back and analyzes and reads through each and every comment, which we can take as a feedback or which we can use to circulate out to more and more people. So please, 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 my humble request, just take out 2 minutes of your time and give us and then share your unique takeaway in the LinkedIn post that I've shared. And yes, I think, having said that, there's something which another additional thing that we have, which we'd love for all of you to be a part of. They say, tell me and I forget it, teach me and I may remember, involve me and I learn. So tell me and I forget it. That's what usually happens, right? Our friends and family and everyone tells you should go and buy term insurance, you should go and buy health insurance, but we forget it. Teach me and I may remember. So we've done that. We've taught you today so that you remember. Involve me and I learn. So what we've done is we've created some community groups over WhatsApp, wherein we keep sharing and lots of information related to your personal finance and how can you make the most of it. There is active discussion by fellow community members. So in case they have some doubts about how do they go about selecting plans, how do they go about investments, or if there are any mistakes that someone has done. I still remember that, somebody was missold a policy from one of the companies, and then, he was very, very sad. And at the same time, he posted about it in the group. And there was another person, and in fact, luckily that person was from that company itself. He was an employee of that insurance company. Both of them were able to connect with each other and then, help them resolve the issue. So that being said, it's a community of all like-minded people who've attended Pennywise workshops in one or the other format. Feel free to join these community. I've shared the link and be an active participant as well. With that, I think we are open for questions, anything and everything that you guys would like me to answer. And in fact, there are people from Shiva's team as well. So if anyone has any specific questions on a certain kind of insurance plan, I'm sure they'll be happy to help. Kunwar is asking a question on any suggestions to buy a term plan from ICICI Pru. I honestly, I'm not. I'd be very, very honest. I'm not learned enough to give you an understanding of which company's plan is better over the other. We've not spent too much time analyzing it. That's something which we don't do. But Shiva, if there's anyone from your team who could answer that, if ICICI Pru is better, or if there are any other plans out there.
Akshat, I think Sharath can answer that.
Sure. Sharath, I guess you're on mute.
Sharath, you're on mute.
Yeah. So we suggest you to take comparison plan from us, or you can compare it online, at least with 2 to 3 insurance companies, and find out the settlement time and the settlement ratios. If you have the answers for these 3 things, then you can choose the right insurer for you. So, or you can touch base with Shiva or Puneet from our team. They'll help you out.
Absolutely, yeah. You can always reach out to us, and also there are a lot of tools that can compare different plans on the internet. You should definitely compare these plans and find the right insurance policy for you. And I don't see any other questions. Please, guys, if you have any questions, put them in the chat box, put them in the Q&A, and we'll be able to answer this for you.
I see Vasu is asking, can you talk about few invest mentors? Sorry if you covered it before. Vasu, I'm sorry, I didn't get your question. Shiva, if we want, can we bring them up?
Sure.
If you want to ask them?
Sure. Let me check if Vasu is available. Yeah, he is. Okay. Vasu, now you can unmute yourself and ask a question.
Am I audible?
Yeah.
Yes.
Yep. So my question is towards, right, normally we see that lots of workshops are happening around how you can invest, but I'm one of those people. Basically, I can say I'm not one of those active people who want to invest themselves. I want somebody to mentor me, and I can take his help, right, his or her help to grow up my money. So can you talk about a bit where I can find those mentors specifically?
I'd say everywhere. The mentors are available. Mentors are available everywhere, right? Why not reach out to help? I mean, honestly, why have one specific mentor, right? I mean, you can have as many people helping you with taking your decisions as possible, right? So if it's about insurances, reach out to Ethika, reach out to Sarath. If it's about investments, feel free to reach out to me. But having said that, I mean, what I suggest is, just go through a lot of books. And I think most of the writers who write particularly on financial education are actively available. Why I'm not suggesting you to kind of go towards an agent or an advisor particularly is because you obviously know, right? I mean, they have their own invested interest in that, yes. And then, accordingly they'll suggest you. Mm-hmm. But for the initial few years, right? Even if you're, let's say, a beginner, or even if you're there in your investing journey for quite some time, I just say read as much as you can and watch as many YouTube videos as possible. Follow as many companies as you can. Try and gain most of their knowledge, and then once you maybe incline towards a thought process by a certain person, that's when you can start following them, right? So, for example, I'm just sharing. I personally, when I started my journey, a lot of people told me, read about Warren Buffett, so on and so forth. I read, however, I personally felt that maybe his investment strategies are a little towards the Western world and may not work on countries like India, right? Yes. So why should I not look at few of the investment gurus that India has, right? Why should I not follow their principle or their books or their advisories? And that's how I started getting inclined to many people who are giving advices out there, right? Okay. So long story short, that would be my suggestion. Don't stop at one. Reach out to as many people as possible.
Okay. Yeah.
Thanks so much for that answer, Akshat. I see a couple of questions coming in. I think Sharath can help us here.
So the question got only 60% claim approved by health insurance as hospital issued bill in the name of package. Hospital is not ready to provide the breakup of the package. How to deal with the situation? So the answer is simple. If there is a room rent proportionate deduction, then the approval amount could have been lesser. Or probably if we can see your bill and what was the hospitalization, then we will be able to better comment on that, why you have got lesser package approved. In case of a cashless, you don't have to pay the 40% of that excess amount. If you have already paid and got discharged, you can go back to the insurance company and ask that insurer or TPA to request the hospital to refund that amount. They will do it. The other question that we have is, do we need to buy a cancer care plan separately other than health insurance? See, I'll tell you, whenever you take this critical insurance or cancer, any specific disease related insurance plans, we are limiting ourselves for the unnamed kind of critical illnesses. Have you ever felt that COVID can be a critical illness? And it came. So what I recommend is, instead of limiting ourselves to cancer or liver or kidney, I will suggest you to have a super top up policy which covers any kind of disease to an extent of cover that you opt. It can be 25, 50, 1 crore, you can opt. So I recommend to have super top up health insurance than any specific disease insurance plan. Can you please share, if someone is having any pre-existing critical disease, can they still get term insurance? And does the
and Sarath, sorry to cut you, but I think there are some sort of correct me if I'm wrong, but I think there are some sort of packages that or some sort of tie-ups that some of the insurance companies have with certain hospitals, right? Could be in network or out of network, and then based on that, I think maybe the hospital that the person went into, Sandeep, who got a 60% claim, could it be because it was an out of network hospital or something like that?
So even in case of a tariff with the cashless facility also, the insurance company mentions that do not collect the money from the patient because it is approved in package. So once we see that authorization, why it was approved 60%, we will be in a better situation to comment whether the hospital has collected it in spite insurer saying not to collect, or was there any other challenge in that?
Got it. And just like he's saying that the insurance company is not providing us the breakup, so is there any way that he can reach out to IRDA or some authority to make the insurance company give the breakup? Is there any process around it?
Akshat, I think it is the hospital that is not giving the breakup, not the insurance.
Correct. Oh, okay. Got it.
Sandeep, probably you can get in touch with us on one-to-one. We will be able to better understand your challenge that you faced, and we can help you with that. Can you please share, if someone is having pre-existing critical disease, can they still get the term insurance? It all depends on the insurer. So when you mention it is a critical disease, if the disease has a nature which is recurring throughout the lifetime, then the possibility of getting a life insurance is almost zero. But again, subject to the latest medical report and the condition that the person has, we have to approach the insurance company by supporting documents. Then they will comment whether they can do it or not, or sometimes they may restrict the coverage instead of what you are asking for. So we can do that, provided if you can give us more more information on that. You can touch base with Shifa or Puneet with the documents that you have. They can speak to the insurers on behalf of you and help you out. Yeah. So the other question from Sandeep is, I faced in the hospital for the same treatment, daycare surgery, 1 day hospitalization for observation, 1.5, 2.5, 3.5 lakhs. I ended up using ward. It's a network hospital. Right. So if it is a daycare procedure, generally, again, here for a daycare surgery, we need to understand more on what treatment they have done and why is the cost of the treatment is so high in a daycare procedure. So, and also it is important for us to understand what terms and conditions your personal policy or a group policy is having there. So once we see that, then we'll be able to comment on this question as well, because these are very particularly processed based on your terms and conditions. So irrespective of the cost, if the insurance policy itself is restricting certain amount to that particular procedure or something, then whatever the sum insured that you have, it will not help. That's why when one important point that you choose when you buy a personal policy is always remember that you are getting a policy which has at least a room rent cover of single AC or which has no room rent limit. Your major burden is taken care of there. Yeah, so you are asking how can I connect with you to check this further? Please reach out to Shifa. Shifa will understand this problem and then she will connect with us. Yeah.
Great.
Yeah, my number is also given. You can speak to me directly as well.
I think there's one open question on the Q&A section as well. Is it better to take two different policies, parents / kids plus individuals, than one family policy?
I recommend exploring both the options. Sometimes, see, the only losing out that when you claim it, when you are clubbing the policy for self, spouse, and children, including parents, the only probability that you lose out when you claim is the no claim bonus in terms of a premium discounting or increase in the sum insured. When you have a separate policies, you can run it as a parallel policy for your immediate family and your parents. You have the comparison made for both the options. And when you see the difference is very minimal, I recommend to have separate policies. And when you're not seeing any difference, or if you are seeing a major difference in terms of premium increase, then you have a combined policy.
Great. Thank you so much, Sharad, for those answers. And I think I see no questions anymore in the chat or in the Q&A. Okay, great. So would just like to take this opportunity to thank Akshat for taking us through this wonderful session. A lot of information on the insurances side. I particularly like Akshat's sessions when he does the calculations on an Excel. It's crystal clear of what you have to do and what you don't have to do, right? Thank you so much, Akshat, for taking us through this wonderful session. Also, would like to take this opportunity to thank Sharad for taking out time from his busy schedule to come and answer questions and give us some inputs on what should be done and what should not be done. And again, thanks so much to participants for taking out time from their busy work schedules and coming in and joining the session, asking their questions, getting all the information. I think you're taking, you're taking away something from the session today that can help you going forward. If there is anything that we can help you with, please get in touch with us. We are readily available to give you sort of any consultations on like any of the insurance policies that you may want to buy now or in the future. And yeah, that's it from us today.
Thank you, Shiva. It's always a pleasure to be here for Ethika. Thanks a lot.
Thank you, everyone. Yeah.
Mm-hmm.